If you're following our Global Economic Outlook series, hit subscribe to stay updated with new country releases. Algeria economy Q2 high unemployment and high interest rate examines the macroeconomic tensions that emerged between 2024 and 2025 when the country faced weak output momentum, persistent joblessness, a restrictive monetary stance, and a rising public debt burden that together created a stagnation environment in the second quarter. Full-year GDP growth slowed to 3.60% in 2024 after ups and downs in the hydrocarbon cycle, and the non-hydrocarbon sectors showed only partial recovery in early 2025, so that Q2 activity failed to produce broad-based acceleration across manufacturing, services, and construction. Labor market strains were especially acute. Official measures put unemployment near double digits, with trading economics modeled ILO estimates reporting total unemployment around 11.43% in 2024. The high unemployment outcome reflected structural rigidities, regionally uneven investment, weak private credit flows, and a retreat of labor-intensive public projects compared with prior plans. Despite modest headline GDP growth near 3.6% in 2024, Algeria's economy entered a period of stagnation by mid-2025, constrained by a difficult policy environment. Unemployment remained stubbornly high, around 11.4%, with youth facing scarce formal opportunities. On the fiscal side, government debt was projected to approach 50% of GDP by the end of 2025. This limited the scope for aggressive stimulus, with spending focused on social transfers rather than job-creating capital projects. While hydrocarbon revenues supported headline GDP, the benefits didn't spill over into manufacturing or construction. With banks tightening lending and consumer confidence subdued, the economy was caught in a feedback loop of low investment and lagging demand, perpetuating the stagnation observed in Q2. In the second quarter of 2025, Algeria's economy faced a period of stagnation, driven by weak output, persistent joblessness, restrictive monetary policy, and a rising public debt burden. Full-year GDP growth slowed to 3.60% in 2024. By Q2 2025, recovery in non-hydrocarbon sectors like manufacturing and construction was limited, failing to generate broad-based acceleration. Labor market strains were acute. Unemployment hovered near double digits, with estimates around 11.43% in 2024. Job creation in mid-2025 did not materially reduce this slack, reflecting structural rigidities and weak private credit flows. Monetary policy provided limited relief. The benchmark interest rate remained elevated near 2.75%. For firms and households, real borrowing costs were effectively higher, constraining capital investment and inducing firms to postpone hiring. Inflation dynamics were volatile. By mid-2025, Algeria recorded surprising negative year-over-year CPI prints, reflecting soft domestic demand. This signaled economic weakness, complicating policy trade-offs. The public finance position amplified the stagnation. Government debt to GDP was projected to rise, approaching the 50% range by the end of 2025. This limited the scope for fiscal stimulus, despite social and infrastructure needs. In the real economy, hydrocarbon revenues supported headline GDP, but didn't spill over into other sectors. Construction and durable goods industries reported weak order books, while banks tightened lending standards, further reducing credit to small and medium enterprises that typically drive employment. Households felt the drag, consumer confidence was subdued, and spending tilted towards staples. Youth unemployment was an acute pain point, with young entrants facing a scarcity of formal opportunities. Looking ahead, reversing the stagnation requires a multi-pronged strategy, restoring credit to small businesses, prioritizing high-multiplier public investment, and improving labor market matching. Without a credible combination of private investment and targeted public projects, the risk is that joblessness remains elevated, perpetuating the stagnation observed in Q2. The policy implications of the Q2 configuration are stark. With debt elevated and funding costs high in effective terms, the government had limited room to finance a large-scale public works push without raising rollover risk or pressuring sovereign spreads, and the central bank could not cut rates aggressively without risking currency instability in a thin external financing environment. In consequence, the policy mix in Q2 tended to be defensive, social buffers were sustained, targeted liquidity support was provided to systemically important firms, and limited concessional financing was mobilized for select infrastructure projects, but comprehensive stimulus designed to reduce unemployment rapidly was absent. Looking ahead from the Q2 vantage, reversing stagnation requires a multi-pronged strategy: restore credit channels to small and medium enterprises, prioritize high multiplier public investment that leverages private co-finance, accelerate measures to improve labor market matching and vocational training, and implement gradual fiscal consolidation anchored in stronger non-hydrocarbon tax receipts. Without a credible combination of sustained private investment and targeted public projects, the risk is that joblessness remains elevated and that real incomes and domestic demand continue to lag, perpetuating the stagnation observed in Q2. The evidence from 2024 into 2025 therefore paints a coherent picture: modest headline GDP growth supported by hydrocarbons, high unemployment near the double-digit range, a policy interest rate that constrained credit in practice, volatile low or negative inflation readings in mid-2025, and a rising government debt ratio that limited fiscal space, all of which make Q2 better described as a period of economic stagnation than as a sustainable recovery. Social consequences include rising poverty risks, youth emigration, and weakening human capital accumulation, while investor sentiment remained cautious pending clearer reform signals. Rapid, credible governance and transparency improvements alongside macro stability measures would raise private confidence and unlock investment, but such reforms require political consensus and time to translate into measurable employment gains and sustainable growth. And jobs. Between 2024 and 2025, Algeria's economy entered a period of stagnation, marked by weak output and persistent joblessness. After GDP growth slowed to 3.6% in 2024, recovery stalled. The labor market was especially strained, with unemployment reaching 11.43% in 2024 and showing little improvement by mid-2025. Monetary policy offered limited relief. The benchmark interest rate held near 2.75%, keeping borrowing costs high for firms and households, which constrained investment and hiring. This weak demand was reflected in surprising negative inflation prints by mid-2025. At the same time, rising public debt, projected to approach 50% of GDP, limited the government's ability to provide fiscal stimulus. This combination of factors created a challenging environment, slowing private sector hiring and subduing consumer spending. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.